Hello everyone, I'm Dimitrios Achilleas from TradeVizion and welcome back to my channel. In my previous video, I introduced you to the TradingView indicator I created based on IBD Market School methodology. Many of you asked for a deeper explanation of what all those signals like B1, B2 and S1, S2 actually means and how to use them to make profitable trading decisions. Today, I'm going to break down the entire IBD Market School system in detail. If you haven't seen my first video explain how to access and use my indicator, I recommend checking this first. You can find the link in the description or you can click the link above. Before we begin, I want to be clear that I am not a financial advisor and this video is for education purposes only. The information presented is based on market techniques and system developed by Investors Business Daily. All investing involves risk and past performance is not indicative of future results. So always do your own research and consider consulting with a licensed financial professional before making investing decisions. With that out of the way, let's dive in. What makes this approach so powerful is that it's not based on predictions, news, or opinions. Instead, it relies on specific signals derived from the IBD Market School seminar to identify when to buy, when to sell, and how much of your portfolio should be invested. The most critical concept to understand is this. Up to 75% of the stock's movement is determined by the overall market direction. You can pick the best stock in the world, but if you buy it during a market correction, it's likely to fail. This system helps you stay on the right side of the market. Before we dive into the specific signals, let's establish a crucial principle. The stock market moves in cycles. It doesn't simply go up or down in a straight line. These cycles can last months or years, and identifying where we are in the cycle is essential for successful investing. The IBD system helps us track these cycles through a combination of signals. The system translates these signals into clear indicators that tell us when to buy, when to sell, and exactly how much of our portfolio should be invested. The core concept of the IBD system is what's called the buy switch. Think of it as a traffic light. When the buy switch is on, like a green light, it's safe to be buying stocks. When the buy switch is off, like a red light, you should remain on the sideline. What controls this buy switch? It starts with what IBD calls a follow-through day. When the market is in downtrend, we wait for a rally day, which is either an up day, what we call a blue day, or a down day that closes in the upper half of its range, what we call a pink day. This rally day becomes day one of our potential new uptrend. Starting on the fourth day, we look for a powerful up day with a volume higher than the previous day. The price gains need to be at least 1% in normal market conditions. This is called a follow-through day or B1 in our system. It's your first buy signal and turns the buy switch on, giving you permission to start buying stocks. Now let's decode all those mysterious terms like B1, B2 that you've seen in my IBD Market School indicator. These are simply buy signals and tells you when to add more money to the market. I will explain each one in detail. Before we start analyzing every signal in depth, let's adjust our indicator to assist us on this job. On the tooltip display mode, change to detailed. On the layout, we will select the detail with 2 columns and signals. And on the buy signals, we're gonna unhide all the signals except the B1, which is the follow-through day. And from the sell signals, we're gonna hide all sell signals. We are not gonna use now any of those. So as you may see now in the chart, it's visible only the B1, it's the follow-through day signals. And also on the tables, we can hover our mouse to get explanation for every signal in depth. Our first signal, B1 or else follow-through day. It's your first buy signal occurring after a market correction or bear market. Must occur on the 4th day or later from a rally attempt and the volume must be higher than the previous day. The price gain must meet a percentage requirement based on the market volatility and must not violate the law of the rally day, which actually is our major law. When this happens, we turn on this buy switch and we reset the distribution count to 0. And on that day, you should invest. Now, how volatility is calculated? IBD determines the market volatility by measuring the average percentage gain of all up days over the last 200 trading days. And up day, it actually means that the close should be higher than the previous day close. So it does not matter if it's closing lower or higher as intraday, as long as it's higher than the previous day. After we collect all these up days over the last 200 trading days, then we average the percentage gain of those to find the volatility of the market. Recently, we are between normal and high volatility. So if it's above 1%, then the requirements for a follow-through day should be 1.25% and so on. As you may observe here, we have one follow-through day that does not match all of our criteria and actually does not have volume higher than the previous day. This type of follow-through day is called by Mike Webster follow-through day in spirit, and we will cover this in depth later on this video. What you need to remember is that follow-through day has a specific definition, and this is what we use here. You should remember that not all follow-through days initiate a new bull market, but the majority of those actually fails. Actually, the 56% according to Mike Webster that he made the analysis does not work. But the follow-through day is more to change your mindset from being bearish to bullish. So you have to take action on that day. If you follow the system, you need to buy at least something to start with. Sometimes the market shows signs that look like a follow-through day, but don't fully meet the strict rules. These are called follow-through days in spirit according to Mike Webster, and I highly recommend it to check his YouTube videos regarding this, and the link will be included in my description. However, in this case, experienced investors like Bill O'Neill rely on judgment instead of just numbers. And some examples of follow-through day in spirits is when we have special volume days like quadruple witching days and holiday shortened trading session, special market events where we cannot actually compare the volume that we have with the previous day volumes to judge if it's clean data, volume data or not. Other reason is the bond market closure. On day when the bond market is closed but the stock market remains open, the volume is naturally lower as many institutional algorithms and programs are out of the market. Also we have partial trading days where the market closes early, so also on that case the volume comparison with the full trading days become less meaningful. And near miss scenario like days that fall just short on the percentage gain requirement but shows other compelling technical characteristics like a strong close, tight spread, huge volume, etc. So being aware of this in spirit situation prevents you from sitting on the sideline with FOMO and while waiting a textbook follow-through day. And remember, as I told you before, the half of the follow-through days fell away, so having a clear exit strategy is more important than perfect entering timing. The ultimate exit rule is the law of the follow-through day. It's actually one way to tell you that the in spirit follow-through day did not work. This case of in spirit follow-through days is very rare, it's not happen very usually. So you can ignore it if you want to strictly stay on the original rules of the IBD Market School. However, in my indicator, you have the option to enable this, where under the volume comparison option, you can just use the quadruple witching or all the expiration option. And if you want to apply this volume comparison signal to follow through day or all signals. As a default, I have the quadruple witching, which is sometimes creates a huge artificial volume. And if in that case we have a follow through day on Monday, then I will compare the volume from the Monday in the Friday's volume, not including the last 30 minutes. From the moment my program is adjusted in order to average all the weekly volume from Monday to Thursday and see if this volume, the levels of this volume, and compare my existing one of Monday if it's above or not. But I'm gonna correct this one and I'm gonna make it based on only Friday's volume, not including the 30 minutes, the last 30 minutes volume, according to latest Mike Webster's YouTube video, where it says that the volume in spirit, actually what I was doing with Williams G&L was like comparing after the 30 minutes every hour the volume to see if this is a follow through day or not. B2 signal is additional follow through days occurring within 25 days of the initial rally day. Must occur with 25 days from the initial day of rally and must also meet exactly the same criteria like follow through day, and also must close above the low of the initial follow through day. Each B2 signal increases our market exposure by another step plus one count. For example, if we have a B1 and right after a B2, then our count will increase from 30% to 55% invested. So also here is the information for the B2, and let's also adjust our indicators to show only the B2 signals, and I will exclude the quadruple witchings, the in spirit follow through days. So here we have the B2 that happens within 25 days from the rally day, and if we go on this day, our market exposure happens to be 30%, and then when we get the B2, we increase to 55% plus the B3, because on that day is not visual here, was a B3 signal, and increase our exposure to 75%. The B3 signal is low above EMA 21, and we buy on an upward flat day when the intraday low is at or above the EMA of 21. We need to note that once we have B3 or B4, we can have another one until it resets by an S5. So we have a B3, the next B3 will happen only after an S5 signal. To see one example where the B3 is printed after an S5, I have just enabling the sell signals and I select the S5, and as you may see here, the B3 was above the 21 EMA, then dropped below, and that triggered an S5 signal. We will talk about this later. So after that, when the market moves above the 21 EMA, then it prints again another B3 signal. B4 signal, trading above 21 EMA. After a B3 signal has printed, we buy on the 5th consecutive day that the low is at or above the 21 EMA. The B4 signal is only printed when the index closes up or a flat for the day. If the index closes down on the 5th day from the B3, then we wait for the next update to trigger the B4. Once we have a B3 or a B4, we can have another one until it resets by an S5. As you may observe here is the B4 signal, and if you count it from the B3, you see that we have more than 5 days. Here we have exactly 5 days. For example, here we have the B3 because it's close, the low is above the 21 EMA, and we count this as number 1, number 2, number 3, number 4, and number 5. This bar is up on the day, so it's pre-did. But in this case, we have a B4 after, let's see this on market analysis. We have a B4, and it's actually after 12 days from B3, and consecutive days above 21 is 6. The reason is not pre-did on the 5th day is, first we count 1, 2, 3, 4, 5 is down day, We was waiting for the up day, but as long as it's broken the 21 EMA low, then I need to count again for 5 consecutive days that is above 21. So I start from here, 1, 2, 3, 4, 5. This is a down day, so I'm going on the next up day, and then we pre-did the B4 signal. B5 signal, or leaving above 21 EMA. After a B3 signal has pre-did, we buy on the 10th day and every 5 consecutive days after that if the day's low is at or above the 21 EMA. The B5 signal is only pre-did when the index closes up or flat for the day. If the index closes down, then we are waiting for the next update to trigger the B5. So here we have a B3, and we start counting from this day, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. This is a down day. The next day also is a down day. So on the 12th day, we have the first up day, so we pre-did the B5. And then from here was the 10, 11, 12, 13, 14, 15, 16. Because all this is down days, we're going on the 17th day and we pre-did another B5. I use the market analysis and helps me to see the counts without for me needing to start counting from B3. Here we have exactly 12 days after the B3. Here is 17 and here is 20 days. We can see also more examples where we have more B5. Here was the 10th day, 15th, here 21, 26 days after the B3 was pre-did. The B6 signal is when we have the low above the 50-day moving average and we buy on an up or flat day when the intraday low is at or above the up trading 50-day moving average. The definition for up trading 50-day moving average is the day that the 50-day moving average is up from the previous day. Once we have a B6, we can have another one until it resets by an S9. So if you may see here, we was below the 50-day moving average, the red line, and when we trend above the 50-day moving average, we pre the B6. Then we have an S9, and then we can have another B6 where the low also was above the 50-day moving average, and also the 50-day moving average is an up trend. B7 or else accumulation day signal. Accumulation day defined as index closes up the percentage requirement for a follow-through day on a heavy volume than the previous day, and a close in the upper 25% of the range. Close must be greater than 21 EMA and cannot coincide with the follow-through days or subsequent follow-through days, which actually means that this can be pre-did after 25 days from the rally attempt, because for the first 25 days we have the follow-through day and the B2 signals. So if you may see here, we have qualified a B7 and this one also a B7, which the volume is higher than the previous day, and they have closed in the upper half range and they are above the 21 EMA. B8 signal, or else higher high. We buy after closing above the last market high as defined by MarketSmith. MarketSmith identifies pivot points by looking 9 bars in the past and 9 bars in the future. If the current bar is higher than the surrounding bars, it is marked as high, and similar for the low. So here we have a marked high by ABD Market School, and if you count, you have more than 9 days on this on the left side and more than 9 days on the right side. So this is marked as high. Once we close above this mark high, then we have a B8 signal. B9, or else downside reversal buyback. After selling on a downside reversal, which actually the S11 signal, we buy back if the index close above the intraday high or the downside reversal within 2 trading days. So the S11 signal is the downside reversal, so we need to close within 2 days above the high of S11 signal. Unfortunately here did not happen, we did not close above this high. So on the next we have another S11 and at that time we close above. There is also one case here, you can see that we close after the second day. We have an S11 here and 1, 2 on the second day. We managed to close above the high of this day, so we print an B9 signal. B10, distribution day fall off. We buy on the day that the distribution count falls back to 4, or else full distribution count minus 2, as long as the close is above the 21 EMA and the buy switch is on. Distribution days fall off when 25 trading days have passed from the distribution day or index moves up 6% or higher from the distribution day close. So as you may observe here, we have the B10 signal and the distribution days is 4. If we're gonna use the market analysis, you will see that on that day we have about 5 distribution days. So when this becomes 4, we trigger the signal. But now let's count 25 days from this day. This is the first bar and go about 25 bars. And as you may see here, we have 1, 2, 3, 4, 5, 6 distribution days. So why we have 4? We have 4 because 2 of these distribution days was fall off because the market rise 6% or more from the close of those distribution days. And we can see that if we select the index rise 6%, and you will see that I have this signal. It does not apply this signal in the market exposure, but is just to show us which distribution days was removed. On this bar, the distribution day that was removed was on July 23 and July 13, but we are indexing now only for the July 13, which is this one. So this one remove this distribution day, and this 6% remove the distribution day on the 21st July, which actually is this one. Because if you measure the close up to the high, it's 6.05, that's why it was removed. And also if we measure from this close to this high was 6.31, that was also this removed. So from total 6 distribution days, we remove this one, and on that day we remove also this one, and we remove this one, so that's why the total count was 4, and that's why we trigger the signal B10. So that was all the 10 signals that IBD Market School is using for increase the market exposure.
but in my script I have additional 3 signals which actually is for indication: the 6% rise and the expired days. The H8, which is higher high, we'll talk about in depth later on, but let's analyze these two. The 6%, as you see also before, when the price rise 6% or more from the last distribution day's close, is gonna remove that distribution day. And also, if the 25 days have passed, then the distribution days that is out of that range also will be removed. So if you want to know where this expiration days is exactly and which one is removed, you have to enable the ED and the index, and then here you may see that on that day we have 25 days expiration, which is February 20th, 21, 24th, and 25th. And for the 6%, the same applies. Higher high signal. This signal triggers when the current close exceeds the highest point since the last confirmed rally without a follow-through day. The buy switch turns on when the close moves above this high. If the price later closes below this high, the buy switch turns off. The H8 signals resets the highest high reached after the buy switch is turned on. During the what if scenario from the IBD market school, they mentioned that there are very rare cases where we may have a rally day, but we don't get a follow through day. And the market is moving upwards. And in that case, we need to find one way to open the buy switch so we can start investing instead of waiting when this follow through day will appear. So in this case, they said that if from the markets moves higher from the highest point of the previous rally, which is our case is here, then we're gonna trigger the H8 signal, which will open the buy switch. We need to remember that this does not remove the distribution count, just open the buy switch for us so we can act on any buy signals later on. And as you may observe, the next day we close below the high of this signal, and then also we switch off the buy switch. As we said earlier, the higher high signal needed only to open the buy switch in case there is no any follow through day after the rally. But if we close below this higher high, if we close below this high, then the buy switch will turn off, and we reset again the highest high to the highest point from this rally attempt. So we close below, that was the market, the highest point, and then after we close above this one, we print another high. The same applies now with the market moved, and then it closed on this day. We close below the high on this day, so that was the highest high, and then when we again the price went above this high, we mark another H8. Just to remember, this signal does not mean that you need to take any action. Only in case the buy switch is not on, it's gonna turn on the buy switch for you to act on any buy signals. Now, here we don't actually need the H8s because we have a power trend, which is also by definition one other way to open the buy switch in case there is no any follow through day.
Just as important as knowing when to buy is knowing when to sell. The IBD system has 14 sell signals that tell you when to reduce your market exposure. Let's go through each one.
S1 or else follow through day undercut. Sell if the index closed below the low of the initial follow-through day. So here we have the B1 and the low of the B1 when it's undercutted, we print an S1 signal. It's important to note that if we undercut the low of the follow-through day, most of the times the rally will fail. The market will move lower, as you may see also on those examples. We undercut the follow-through day's low and the market move lower than the initial rally day, which also has a major low, and then we create another rally and so on. S2. Fell rally attempt. Sell if the index undercuts the major low of the rally attempt. Market exposure is reduced to zero and the buy switch is turned off. Here was the major low of the rally attempt, and when we undercut it, we create the signal S2. Same happened here. Same on this one, and then a new rally on the next day. Same also here, and so on. S2 minor low. This signal is created when we undercut a minor low of a rally attempt. The market exposure is reduced by 2. This does not turn off the buy switch. A minor low is defined as the low that occurs when the distribution count is full, requiring a new follow-through day to reset the distribution count, and we still have exposure in the market. Here we have 90% and distribution days 6. So we have full distribution, and from this moment and after we need to see a correction in the market, and on the first up day we will create a new rally attempt. So here was the last low before a new rally created, so this one is considered our minor low. So now we need to search for a B1 to reset the distribution, but if we will undercut this low, then we're gonna create the S2 minor low signal, which actually happened on the next day. But still we have full distribution and market exposure, so we are continuing to search for a new rally attempt. So you have a new rally attempt here, and now this low of the rally attempt is marked as the minor low, and we search now for a B1 to reset the full distribution count. So here we have a B1, and the next day our distribution count was reset. So this is all about S2 minor low and what minor rally actually means and how we handle. S3, full distribution minus 1. Sell after distribution count increased to 5, and this rule is applied each new time it occurs. So here we have an S3 signal, and if we see over the last 25 period, you will observe that from here first bar and we going up to 25 bars. So we have 1, 2, 3, 4, 5 distribution. On the next day, we have 4 distribution because this is going out of 25 days. So that's why we have also expiration day here. And now our full distribution from 5 became 4. And because on the next day we have another distribution day, we generate a new S3 signal for that reason. S4, full distribution. This signal is generated when we have a full distribution count, and this rule is applied up to 8 days, full distribution plus 2. So on this day, we have exactly 4 distribution, because if we count over the last 25 periods, you will see we have 1, 2, 3, 4, 5, 6, 7, 6 distribution in one standing day, but this distribution was removed because of the 6%. So actually we have 1, 2, 3, 4, 5 plus a standing day. So we have total 6 distribution. So this day we generate the S4 but if we have a new distribution day, like this day, then we generate another S4 because now distribution is 7, and then we continue. And on this day, we have total 8 distribution over the last 25 days. So that's why we generate another S4 signal. S4 extra. This signal is printed when the total distribution days count jumps directly from 5 to 7 in one bar, and this is because of the addition of a distribution stalling days. So the S4 extra actually is the S4 signal, but printed 2 times on the same bar. And in order to make it more easy to see the difference, we call it S4 extra. As you may see here, not including the last this bar where the signals were generated, if we count from here up to 25 bars in the past, you will see we have 3 distribution days and 3 stalling days. But there is a rule that we don't count the stalling days that are more than the distribution days. So actually we have 3 plus 2. So total 5 distribution days here, because we cannot count the third stalling day. But on this day, we have also an additional distribution and make our total distribution count to 4. So now we can add all the 3 stalling days up to that period. So from 5 distribution count, we jump to 7. That's why we generated 2 times the S4 signal, like S4 and S4 extra. S5, break below 21 EMA. If the index closed by 0.2% or more below the 21 EMA, we generate the S5 signal. Once we have an S5, we can have another one until it resets by a B3. So here was the first time we closed below the 21 EMA by more than 0.2%, and that's why we generate the S5 signal. Then it resetted by the B3, and once we close again below the 21 EMA by more than 0.2%, another S5 signal, resetted by B3, another S5 signal, and so on. S6, overdue break below 21 EMA. Sell if the index closed down by 0.2% or more below the 21 EMA after 30 days have passed since the last B3 without triggering an S5. Once you have an S6, you cannot have another one until it resets by B3. So actually, if you see here, the B3 was generated, and after 51 bars, we break below 21 EMA for first time. So there was not any S5 prior to this, and it was above 30 days. That's why we generate the S6 signal, and also at the same time is the S5. S7, trading below 21 EMA. Sell after S5 on the 5th consecutive day that the high is below the 21 EMA and the down day. If the index closes up on the 5th day from the S5, then wait for the next day, which will be down to trigger the S7. We can have another S7 until it resets by B3. This is exactly the opposite from the B4. So in this case, we have S5, but on the next day, our high is not below the 21 EMA, so we move on the next. Here's the first time, but we break above 21 again, and then here is the first day where the high is below the 21, second, third, fourth, and this is the 5th day, and because it's a down day, we trigger the S7 signal. And we cannot have another one until a B3, and so on. S8, leaving below 21 EMA. Sell after S5 on the 10th and every 5th consecutive day after that, and at the high is below the 21 EMA. The S8 is only triggered when the index closed down for the day. If not, then wait for the next down day. So here we have the first S5 where the price closed below the 21 EMA, And then if we start counting from here, 1, 2, 3, 4, 5, 6, 7, 8, 9. On the 10th day is a down day, so that's why we predict also the S8. 11, 12, 13, 14, 15, 16, and 15 is an update, so on the 17th day we predict another S8. So for me to assist me not counting, I'm using the market analysis. So I confirm the times passed from the S5. Here is 17, and this is about 20 days, and here is 27 because the 25th and the 26th was up days. S9. Sell if the index closed below the 50-day moving average. Triggers only if a B6 signal was previously predicted, and exceptions of this rule is if the index closed in the upper half of the range and within 1% of the 50-day moving average, then the signal is not triggered. Once we have an S9, we can have another one until it's reset by a B6. So here we have a B6, and the first time that the price closed below the 50-day moving average was here. That's why we print an S9. Then another B6 was printed on this bar, and right after we close again below the 50-day moving average, and we trigger another S9 signal. S10. Bad break. Sell if the close is down by 2.25% or greater in the bottom 25% of the range. Close below the 50-day moving average or intraday's high is below the 21 EMA. So on this signal S10 we have both options. We have close below the 50-day moving average and also the highs below the 21 EMA, and the price drop more than 2.25 and actually is almost 5.16%. Here we have the case where only on intraday the high is below the 21 EMA, and we have closed more than 2.25, more than 2.25. Actually, we close 2.55 on that day. That's why we trigger an S10. And here is one case where only we close below the 50-day moving average while the high is above the 21 EMA. However, we close more than 2.25. Actually, we close by 2.26. So that's why we trigger the S10 signal here. S11, a downside reversal day. As a downside reversal, we mean when we have a new high within 13 weeks and we close in the bottom quarterly of the range, and the bar is down for the day and the spread is 1.75% or greater. So on this day we was on the new highs within 13 weeks, and we have closed down for the day on the lower quarter, and the spread was more than 1.75%. That's why we create the S11 signal, and it happened again on the next few days. We'll have a new high here, and then we close again down with all the criteria for S11 signal. S12, lower low. We sell after closing below the last marked low as defined by MarketSmith. MarketSmith identifies pivot points by looking 9 bars in the past and 9 bars in the future. If the current bar is lower than the surrounding bars, it is marked as a low. And similar is for the high, where we have also the B8 signal. So here on this day, we broke below the marked low that was on this bar. That's why we predid the S12 signal. S13, distribution cluster. Distribution and stalling days increase to 4 up to 8 days within a rolling 8 days period. The distribution cluster changes the power trade if it is in effect to a power trade under pressure. As you may observe here, the last 1, 2, 3, 4, 5, 6 days, you have 3 distribution days. So if the next day will be another distribution day that will be create a cluster from 3 to 4, and it will trigger our signal S13. So, and actually on the next day we have an stalling day. So now we have within 8 days 3 distribution and 1 stalling day, which actually 4, and this creating our first cluster, and we get the S13 signal. Also the power trend, which was in effect, now is under pressure. Once we have our first S13 signal, which corresponds to a cluster 4, because within the last 8 days we have at least 4 distribution or stalling days, we will keep getting additional signals if those distribution and stalling days increase within the 8 period, as happened on this chart here. S14, break below higher high. Sell after closing below the last marked high as defined by MarketSmith that predid a B8. So once we broke the marked high here, we predid a B8, and if we will close again below this marked high, then we trigger an S14, which happened exactly the next day. Same here, we break above, we trigger a B8 signal, and because the next day we close below this marked high, we print an S14. Same here. This happened after a few days. We break here the B8, and then after a few days we break below this marked high, and then we have another S14 signal here. Circuit breaker signal. If the index drops 10% from the highest high since the last follow-through day and falls 5% or more below the 50-day moving average intraday, then the circuit breaker is triggered immediately. Alternatively, if the index closes below the 50-day moving average and is in the lower half of the range or more than 1% below the 50-day moving average, then the circuit breaker is triggering at the close of the bar. The market exposure on this case is forced to 0, 100% cash, and the buy switch is turned off and the power trade ends. So in this case, we have a rally here, a B1, and because the price drops more than 10% with gap here, we trigger the circuit breaker. Also, we was below the 50-day moving average and below the 21 moving average, so this signal triggered immediately. Here we have one case where the circuit breaker triggered at the close of the bar, and the reason was because it was below the 50-day moving average, more than 10% from the last high after a B1 was triggered, but was not more than 5% below the 50-day moving average. And that's why we was waiting at the end of bar to see if this bar will close below its half range and up more than 1% from 50-day moving average. Distribution day. Distribution day occurs when the market closes down by at least 0.2% on volume greater than or equal to prior day. So on this bar, we have higher volume than the previous day, we close down, and also we close more than 0.20%. Actually, we close by 0.82%, so that is a valid distribution day. Stalling day, a sign of heavy volume without further upside progress, occurs when the market is at near of new highs and it meets the following criteria. The volume is at least 95% of prior day volume, the close is in the lower half of the day's range, and the closing price is on one of the 2 previous days for at least 0.2% up, and the intraday high is greater than or equal to the high of the prior 2 days, or the prior day's high, and within 3% of 25-day intraday high. So there are a lot of rules for the standing days. However, here is some indication. What actually meant to be is we have a new highs with volumes higher than previous day, but the price is not having any progress. That indicating a stalling. It is a signal of probably market stopping.
One of the most powerful aspects of the IBD system is something called power trend. This special condition provides additional protection during strong bull market to keep you from exiting too early due to normal market volatility. A power trend is activated when these four conditions are met. First, the 21-day moving average is above the 50-day moving average for at least 5 consecutive days without a prior S9 signal. Second, the 50-day moving average is in an uptrend, meaning it's rising for at least 1 day, which actually means to be higher than the previous day 50-day moving average. Third, the market's lows remains above the 21-day moving average for 10 consecutive days. And fourth, the market closed up or flat for the day. When a power trend is active, the buy switch remains on regardless of distribution or count. Your count can go up to +7 instead of just +5, giving you a buffer against sell signals. We don't act on anything higher than the +5. The rule was created to provide a buffer, not for additional buys. And a floor is established at count 2 or 55% investing, preventing you from going below this level. This is a game changer because even if you reach zero exposure due to sell signals and have the full distribution, your buy switch stays on. You can immediately act on buy signals without waiting for a new follow-through day. The power trend can be placed under pressure by certain sell signals like S2 minor low, S13 distribution cluster or S9 signal, and eventually turn off when the 21-day moving average goes below the 50-day moving average and the market closed down, or an S2 major signal or circuit breaker signal was activated. Let's walk through the 2020 COVID crash and recovery to see how this system works in real time on Nasdaq index. In February 2020, the market was at all-time highs, count 5 and fully invested. As COVID concerns grow, distribution days appeared. The market broke below the 21 EMA, triggering an S5, and then broke the 50-day moving average, triggering an S9 signal. And because it closed in the lower quarterly range of the day with more than 2.25% drop, we got an S10 signal as well. Additional, on the same day, we reached 5 distribution days, which also triggered an S3 sell signal. All these multiple sell signals reduce our exposure from 100 to 30% in 1 day. And on the next day, we was completely out of the market with count 0, telling us to be all in cash. Our buy switch turned off a few days later on the 27th of February because of the circuit breaker signal. Then we was waiting for a follow-through day to start investing again. On March 23 we got the rally day, or else day 1 of the new rally attempt, and on April 6 we got the follow-through day, or else B1, turning on the buy switch and increase our exposure to 30%. When the market low moved above the 21 EMA and closed up, we got an B3 signal, and additional follow-through days appear later on, which is actually the B2 signal. We saw also the price trading above 21 EMA for 5 days after the B3, and we got a B4 signal on the first up or flat day. By the middle of April, we had enough buy signals to be fully invested again. Those who followed this system will have avoided the worst of the crash by going to cash, re-entering the market near the bottom and capturing the entire recovery rally. Now let's talk about how to implement this system in your daily routine. It's only take about 50 minutes per day once you understand the signals. Your daily market analysis consists of the following signals. First, check the major market average. I recommend focusing on Nasdaq Composite. Then identify any new buy or sell signals that have triggered it and update your count from 0 to 5. Adjust your market exposure if needed and scan for individual stocks meeting your criteria like strong earnings and proper base. And finally, execute any required buy or sell orders. I've created the TradeVizion script showing in my previous video and here precisely to make this process easier. The script automatically identifies all the signals for you so you don't have to manually calculate each one every time. When your count increases, here what to do. Look for stocks with strong fundamentals, 25% or higher earnings growths. Focus on market leaders in strong industry groups. Find stocks forming proper bases like cap with handle, flat base and others. Buy only when they are break out of these bases on strong volume and use 7 to 8% stop loss on all positions. When your count increases, reduce your overall exposure according to the count system. Sell your weakest position first, those showing the poorest relative strength, and considering trimming even your stronger position to maintain proper portfolio allocation. Raise cash methodically, don't panic and sell everything at once. And prepare a watch list of strong stocks for when buy signals return. In conclusion, the IBD Market School methodology gives you a systematic, rule-based approach to navigate the market. By following these signals, you will enter the market at the right time after a follow-through days, and you will add exposure methodically as the trend strengthens. You will reduce exposure when warning signs appear, and you will exit completely before major damage occurs. And you will re-enter at the next confirm up trade. This approach removes emotions from your investing decision. You are no longer guessing about market direction or being swayed by news headlines. Instead, you are following what the market is actually doing through price and volume action. Remember that no system is perfect and you will face whipsaws occasionally. The advantage of this approach is that your losses will be contained while your winners can run for substantial gains. I hope this detailed explanation helped you understand what those B1 and B2 signals in my trading scripts really means and how to use them effectively. In my next video, I will show you how to combine this market timing approach with specific stock selections criteria to find the biggest potential winners. If you find this valuable, please like the video, subscribe to the channel and share it with others who might benefit. Drop any questions in the comments below and I will do my best to answer them. Thank you for watching and I will see you in the next video.